Welcome to Money, 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 your weekly personal finance date with me, Surabhi Upadhyay. Another year draws to a close, and it's one that's been quite a roller coaster for investors. While 2018 may not exactly have been a blockbuster year in terms of actual market returns, if you've got your personal finance plan in order, you wouldn't really have had too much to worry about this year. Well, today, on this very last episode of 2018, we look back at the year gone by and, more importantly, talk about the trends that are likely to shape wealth creation in 2019. Joining me to do that are Abhijit Bhave, CEO of Karvy Private Wealth, and in a bit to talk about the prospects for physical assets like real estate and commodity. To get us that outlook for 2019, we will have with us Sameer Jasuja, co-founder Prop Equity, and Kunal Shah, head of commodities and currency research at Nirmal Bang Commodities. So let me start with you, Mr. Bhave. Thanks very much for joining in. It's been quite a year. I mean, quite a year of ups and downs and topsy-turvy, changes in taxation, LTCG and whatnot. When you look back at 2018 and you think about what all happened in wealth management and wealth creation, what's the first thing that comes to mind?
So let me start by wishing your viewers a very happy 2019. May 2019 be the best of your year of our lives. 2018, when I look back, you know, two words come to my mind: less and lesson. It was a year of less returns. It was a year of many lessons.
Yes.
So there were a lot of happenings globally, but if you look at the equity market, I think the index would typically only end up going up 6 to 7%. And the returns would be ranging from that level to negative returns in equity. If you look at the debt markets, we had a lot of turmoil with interest rates wavering, going up and down.
We had the benchmark yield cross 8%, then slide back down to less than 7.5%, all over the place.
It's roller coaster, and to add to that, the entire ILFS fiasco.
Yes.
So even in debt funds, people saw returns which were from 1 to 4%. So a lot of lessons for investors who were looking at mega returns in 2018.
Yeah.
So one major lesson is that asset allocation matters, but so also sub-asset allocation. So when we started the year, I remember we were telling our investors at Karvy Private Wealth that within equity, at least 50% should be large cap. And then there was greed coming in. A lot of people thought they will get returns of 30, 40, 50% and go into
mid cap and small
cap. They got 30, 40, 50, but minus 30, 40, 50. So that is a problem. Secondly, we had said that in debt, also do not go for duration of credit plays just to get that 1 or 2% extra. Focus on short-term debt and focus on fixed maturity plans. If that was the core of a portfolio, large cap and fixed maturity plans or short-term debt, people would have been better off. These are the two lessons on equity and debt.
And absolutely, I mean, as one always says, that if you've got your long-term goals in mind and you didn't have the need to suddenly sort of go out and, you know, rejig your portfolio, go sell when the market is low, then of course it wouldn't have mattered. But if you are in that category, then really a year of lessons, as you were saying. So the question here is now, you know, you've also, of course, undertaken the India Wealth Study. That's an annual report that Karvy brings out. And I was looking at some of the findings. Interestingly, and this is, of course, a 2018, financial year 2018 study, but I think I mean, a lot of this extrapolated for the calendar year as well. So the good takeaway is that financialization of savings continues to happen.
Absolutely.
There's a lot of money moving now in equities, in mutual funds, and actually fixed deposits have declined in the year that's closed out. So why don't you just throw in some of the highlights of the study as we go forward?
So actually, you know, if I take you 75 to 100 years back, people were investing only in gold and real estate. And in economics, we have a curve called the J curve, where it gradually goes up. From 1991, people have been putting more money in financial assets, more so in the last 4 to 5 years. So our findings for this year has been that overall wealth, it has been a very good year. Overall wealth has gone up by 14%, but financial assets have gone up by as much as 17%. Now, if you look at the overall financial assets, the top five are direct equity, fixed deposits, insurance, savings accounts, and cash. Now, fixed deposits, the growth rate has gone down because fixed deposits have not got a negative growth, but growth rate has gone down.
That means lesser money that has gone into FDs this year.
Absolutely.
Okay.
And FDs was #1 last year. This year, equity is #1. And you know, interestingly, insurance always is in top 3 for the last 9 years. We have been doing the study, and even today we are at such a low penetration levels that we are less than 4%. So insurance growth would keep on happening. But if you look at going beyond that, mutual funds, by the way, 60% is now equity funds. And more than half the industry is individual investors. So we believe that the trend is going to keep on growing. You know, this year, if the numbers are right, around 85,000 crores were taken out by FIIs from debt and equity put together. But $1 billion came out through SIPs every month. If this year this kind of money had moved out and retail investors had not put in the money, the stock market would have crashed. And they have not. And that is a big takeaway for the year. So tomorrow, next few years, when the FIS come back in and the retail investors also continue, the market would go at different levels.
So now, you know, this retail investor that's really kept the faith through this year, through that SIP route, is also a little confused at the moment because you've come off a, you know, a very dull, lackluster kind of a year. Now, there is a temptation because the mid-cap index is still down 19-20% for the year. So there's a temptation that maybe mid-cap funds will do really well in 2019. What is your advice, first of all, when it comes to equity investments for the year that we're entering?
So, you know, if you look at 2019 and beyond, first of all, nobody should invest in equity for 1 year. So we are very positive on equity as asset class. In fact, we are saying over the next 7 years, the Sensex would treble to 1 lakh. And we are
1 lakh.
1 lakh, you know. So in fact, you know, normally if you look at people, they talk of only one E, and that E is election. This is the election year. And for the last 2 decades, elections have come and gone. Markets have moved in the direction that they have moved. The 2 E's we are talking about actually are economy and earnings. And we believe that earnings growth, which have not been happening for a long time, would be in the range of 18-20% over the next 7 years. And to add to that, we believe we'll have a PE rating. And that would typically be in the range of 2021. That would take the market up. The CAGR, by the way, is less than 16% for a trebling of market. And for the people who have short memories, 2003 to 7, in 5 years, the stock market had gone up 6 times.
That's true.
So it's fundamentally, we believe that markets will move. But coming back to your question, you know, if you look at 2019, we are saying you should be equity overweight. So if a conservative investor is normally 50% equity, he should be 60%. Within that, so let's talk of only mutual funds to begin with. So within that, 50% should be large cap mutual funds.
So you're sticking to that advice that in your portfolio 50% make sure it's large cap.
Yes, because you have better corporate governance, you have better surety of earnings, and you will not have those upswings and downswings coming in. 20% should be multi-cap. 20% can be mid-cap and 10% sectoral. Our preferred sector is banking and financial services.
Very, very interesting. So after all the turmoil, you're still going as a thematic play. If one needs to go in, then maybe a banking fund. Let me actually take some fund names. If you could advise our viewers, that would be very helpful. Since large cap is a play that you are, you know, anyway interested in, I think multi-cap and mid-cap is a category that people really want to sort of dabble in and want to know if great returns will come in. So some names perhaps.
So if you look at large cap, we prefer 3 funds: ICICI Prudential Blue Chip Fund, we prefer HSBC Large Cap Fund, and SBI Blue Chip Fund. And again, I'm saying look at the long term, which is at least 3 to 5 years. Don't look at a 1-year investment. You buy and you hold.
So that's large cap. Now let's come to the more interesting, the masala bit of it, the multi-cap, mid-cap, small-cap category, where you're saying not more than 20% of the portfolio should go. But again, how are you choosing the funds? What are your preferred funds?
So we regularly keep on meeting the fund managers, and finally, you know, it is the man behind and the process behind the investment. So our view is that if you look at multi-cap, the top 3 funds that we would recommend today are Kotak Standard Multi-Cap. We would recommend a Mirae Asset India Fund. And we would recommend a UTI equity fund.
Okay, fair enough. So that's you know, quite a bit on equity. Ladies and gentlemen, you have some ideas to work with as far as your equity investments are concerned into mutual funds. But we're not done when we're talking about financial investments, and there is fixed income. And there are so many things you can do there. There are mutual funds, there are the good old you know, post office schemes and the other saving schemes, there are the fixed deposits. What is the best bet for 2019? We talk about that on the other side. Welcome back to the last episode of Money, Money, Money for the calendar year 2018. It's a rewind episode, and more importantly, it's a look ahead to 2019 and the kind of wealth management, money-making trends perhaps that we will see in the coming year. So, Mr. Bhave, we've discussed equity in great detail. Now, the importance of fixed income, of course, cannot be emphasized enough. Now, here is where it's been a roller coaster ride, as we discussed. So people are confused that, you know, because of this ILNFS event, suddenly you don't know if even your accrual fund might start showing losses. You know, there were mutual funds suddenly selling certain types of paper in between in September, those memories. What is the lesson there? And on fixed income funds, what would you recommend for 2019?
So the clear lesson is be careful. And so a person goes to debt because he wants to take less risk and get a reasonable return. And if you want to get that 1 or 2% extra, I think this is not the year to take that risk. If one puts that, looks at where to put money in 2019, starting with mutual funds, we are clearly saying not a year to go and look at the credit risk or the duration risk. Stay away from the duration play and credit play. Look at short-term debt funds.
So short-term funds would be funds which are investing in paper, which would be of 3 to 6 months maturity. Don't go beyond that. Okay.
So we have Reliance short-term fund, Franklin India short-term fund, and Baroda Pioneer short-term fund as our top picks. We are also looking at ultra short-term funds for parking money, and there one can look at SBI ultra short-term fund and Franklin Templeton ultra short-term fund. So that's for mutual funds. We are also saying that look at fixed maturity plans with the tax angle. You have a locked-in return, and you don't have the ups and downs of the listed debt funds.
And what are the kind of underlying securities that typically a fixed maturity plan would invest in?
So you should typically go for a AAA or a AA fixed maturity plan, and in fact, this is a very interesting question because, till last year, people were assuming NBFCs as the same risk profile as a bank.
Sure.
So one should go to the financial advisor and try to see where he or she can get the best rated papers.
Absolutely. So you stay invested for 3 years. When you come out of it, it becomes tax efficient as well with the indexation. Now, beyond the mutual fund universe, as you were saying, I mean, traditionally, India has always invested in fixed deposits or in postal saving schemes or the national saving certificates, the usual small saving schemes. Do these also appear on your radar? Because I saw something quite interesting. It seems that the Sukanya Samriddhi scheme launched by the government a couple of years ago, that's drawing in a lot of money. Is that right?
So this entire Beti Bachao, Beti Padhao campaign, I think that has got the eyeballs. But more importantly, people are looking at very long-term investments for a particular goal, which is pure financial planning. So we have actually seen a 50% growth of money moving into Sukanya Samriddhi scheme. And for somebody who has a girl child, I think it is a good investment because you have a government guarantee, you have a fixed return, which is a slightly reasonably high return. The other thing one should not miss out, though it is not pure debt, but one should not miss out is NPS.
Absolutely.
Because there also you have a debt equity combination and you get a straight tax break.
Oh yes, and the tax breaks have increased. In fact, let me quickly tell our viewers that we will of course get you more detailed conversation on this, but a note to keep in mind that now the entire 60% of the corpus that you will get to withdraw upon retirement becomes tax-free. 40% of course has to go into compulsory annuity, but earlier you got tax rebate or a tax-free corpus of only 40%. 20% was taxable. That has been done away with, so 60% becomes tax-free.
That is one more angle, once you finish section 80C, there's nothing left for you. For NPS, you get 50,000 more.
The additional deduction.
And if you are in the top tax bracket, you're actually getting a break of 33%. So return on investment day one is 33%.
Right.
Plus you get 8%, 10%, 12%. So I think it's a fantastic investment. People who are self-employed should definitely look at PPF because that gives you a good return and gives you a tax saving also.
Okay, great. So let's just recap this. When you're talking about fixed income or the debt part of your portfolio, then if you want to go into mutual funds, then Mr. Bhave is recommending either short-term funds or fixed maturity plans. Beyond that, PPF always a good idea because it's EEE, exempt from a tax point of view. NPS is something you could look at, and of course the existing savings, and I think people tend to have some liquidity in the bank, some fixed deposits, etc. That continues. All right, now that takes care of the financial assets that we have discussed so far. But what will 2019 perhaps have in store for real estate and gold? Let's admit it, we're Indians. We do like a bit of the physical assets in our portfolio as well. We get you an outlook on the other side of the break. Welcome back. You're with Money, Money, Money. This is the year-end special. What will 2019 have in store when it comes to wealth-generating ideas? We've discussed mutual funds, we've discussed equity, we've discussed fixed income. What about real estate and gold and other commodities, perhaps? Let me introduce two more voices on the show. Sameer Jasuja, co-founder, Prop Equity, as well as Kunal Shah, head of commodities and currency research at Nirmal Bang Commodities. Gentlemen, thanks for joining in. Season's greetings to you. Thank you for being with us on the show. Sameer, the big question to you. If we're talking real estate, then if you were to encapsulate 2018, how would you look back at the year gone by?
So 2018 has really not been a very good year for residential real estate. There has been hardly any appreciation. We were saddled with oversupply and also with execution concerns, especially from Category B developers. And although Category A developers did pretty well, but on the residential asset class, it's been a year that very well we would like to forget. Although there was some execution that was done by Category B developers thanks to the NBFCs who funded them, and that's going to be a challenge going forward. On the commercial asset class, it has done exceedingly well. The commercial asset class has probably been the best year ever. 2018, especially for rented out assets, and there's been a lot of FDI investment that has come into that sector. But having said that, 2019 is going to be a very different year compared to 2018.
Okay, why do you say that? And let me break this down. Let's start with the home buyer first up. We're not talking about investors just yet. What might 2019 bring for the home buyer?
Sure. So on the residential side, I would like to divide the residential asset class into three buckets. The first bucket being of ready homes. As far as ready homes are concerned, especially for the home buyer, he should close his eyes and go and buy now. Probably the best time to buy. Ready real estate is doing pretty well. In fact, areas like South Delhi and certain other areas have started to appreciate even because there's very limited supply in the ready segment. The second bucket is the under construction segment, which has been launched over the last 3 to 4 years. That segment is going to do not so well. Please be very careful. The third bucket is the new under construction launches, which have been done by Category A developers, the Godrej, Mahindras and the Tatas of the world. Those are very safe. Those are being launched at good price points, and they are newer assets. So those are areas where you can look at buying, and there are subvention schemes available in those asset classes. So that is something that you can look at.
Okay, I think that's sound advice, and one should perhaps keep a lot of that in mind as well. Let me get your thoughts as well, Mr. Bhave. On real estate, what are you advising people for 2019? And right now we're talking about people who actually want to stay in the houses.
Yes.
We're not talking pure speculation or investment.
So since we spoke about Delhi, let's talk about Bombay. Mumbai's population is 22 million, which is same as the population of Australia. And there are more people coming in. And there's the only way to go up is vertical. So in the long term, real estate is going to come back into a hot asset investment class, but whether that will start in 2019 or 20, that's anybody's guess. If somebody is looking for a place to stay, I agree with him. We should look at a Category A developer and look at schemes where you actually pay only 20% now and you start paying the interest rate on the home loan after 3 years.
But the question is, should one wait for some sort of a capitulation in prices, as Sameer also mentioned with this NBFC crisis, and now that everybody's tightening their purse strings, is it better to wait for a better time, I guess?
So to get good returns, you have to be always ahead of the curve. And at Karvy Private Wealth, we are actually recommending people to look at real estate as an investment. Start looking at it. There is no hurry. But you can't, just like in the equity market, nobody can time the bottom. In any asset class, you can't time the bottom.
Okay, fair enough. Sameer, so let me ask you this. What are your hottest pockets in terms of geography for 2019? Sameer?
As far as real estate is concerned, I'll go city-wise. I think Bangalore is a safe bet. It is doing pretty well. It's an end-user market, and there is a decent amount of demand over there. Other than that, at this point in time, 2019, from an investment point of view, I'm not recommending. From a home buyer point of view, I would suggest you could buy anywhere. You're going to get very good price points, and probably the prices are going to inch up higher with respect to the ready segments.
Okay, so there we go. Lots of food for thought. If you're looking at real estate, the market really seems to be in a churn. On that note, let's expand this forward to the commodity segment as well. We have Kunal Shah with us. Kunal, we've discussed financial assets, physical assets like real estate, and now it's time to talk commodities and the precious yellow metal gold. It's again volatile, been all over in the last 1 year. I mean, above $1,300 an ounce, below $1,200, now somewhere at $1,250. What lies ahead?
Well, as far as gold is concerned, we've seen a very sluggish year this year, mainly on account of two reasons: stronger US GDP growth rate and the Federal Reserve hiking the rate. These are two main reasons why gold could not perform well, and India-China jewelry demand was relatively weaker. But I think global economy has entered into uncharted territory, where with the Federal Reserve curtailing down its balance sheets, cutting down its balance sheets, with Federal Reserve moving up its interest rate throughout last 2 years. What's going to happen is anybody's guess. No one knows what's going to happen. So we are entering in an uncharted territory where ECB bond buying have stopped and all sort of uncertainty prevails in the market. So in this kind of environment, gold is likely to perform extremely well. I believe that 2019 is the year of gold, and we remain very bullish on gold. We were bullish, and we think that we have all the reasons to remain more bullish on gold, because every month the liquidity is getting out of the system. $40 billion Federal Reserve is really sucking every month out of, and they are reducing their balance sheet, and that is causing unimaginable volatility in all the financial instruments.
Sure.
China is slowing down, US growth is expected to slow down,
sure.
Global GDP is likely to slow down. So I think gold prices are going to definitely move up.
Let me ask you to put a number to that. How much in 2019? 10%, maybe more? I mean, some sort of a guesstimate?
Okay, I'll be little, I won't be conservative, because I think it's a right time for the Indian people, the viewers, to invest in gold. I'm expecting conservatively gold prices to test $1,450 to $1,500 during the year 2019.
Wow.
Maybe during the first half, maybe during the second half. But the scenario looks, the stage is set. And on Indian bourses, considering the rupee volatility, conservatively 35 to 36,000 is on the cards for the gold in year 2019.
Okay, wait, gentlemen, I think I need to go back and check my own portfolio. I don't think I have any gold in it, but definitely, Kunal, you got me thinking. Mr. Bhave, your thoughts? Come in on this, and I'll now broaden this out to discuss all asset classes. If you're looking at the pie for the year 2019, I mean, personally and in terms of recommendation, what would you go with?
So interestingly, though the gold prices went up around 7% this year, we have seen a degrowth in the portfolios of gold ETF. So as far as we are concerned, you know, for a normal investor, the core would remain equity and debt, but gold remains an integral part of the portfolio as a hedge.
Okay.
And it is a crisis currency. If something really goes bad, there's gloom and doom, we recommend typically 5 to 10% of gold. And howsoever we might tell people not to buy gold, Indians will end up buying gold. For HNI, somebody can take a call and say that I am bullish and I want to invest in gold. But for a normal investor, we would say not more than 10% gold, and most of that comes as jewelry already.
Okay, all right. Kunal, let me ask you this. Beyond gold, are you expecting this glitter to spill over to any of the other precious metals? I mean, whether it's, palladium, platinum, silver, and also maybe a word on base metals. Now, as retail investors, it's very hard for us to invest here unless we are, in the futures market, in the commodities market. But what's the call, generally speaking?
Other precious metal also looks bullish. Along with gold, even silver prices are likely to move up going forward. And I think when you ask about the other commodity complex, when you say it in base metals and when you talk about the energy complex, so the base metals, we are not expecting any significant upside, even though the supply side continues to remain weak in most of the metals. But the fact is that the demand growth rate of China, which is consuming more than 50% of the base metals, is collapsing. Even energy oil, the market is heavily supplied. 1.2 million barrels of production cut is not going to take oil to again $80. So in commodity complex, gold and silver are something one should watch out for. Remember, Mr. Trump is also after the weaker dollar. Mr. Trump doesn't like stronger dollar, and 2018 belonged to Mr. Trump. So I think if the dollar weakens, it will shoot up quite sharply. Okay. So gold and silver are the commodity for 2019.
Gold and silver are the commodities for 2019. So we're coming down to last thoughts, gentlemen. Now let me ask you to do this. Samir, I'm going to start with you. As far as your personal portfolio is concerned, your personal finance portfolio, where are you putting your money in 2019? Give us a quick asset class breakup.
Well, I also happen to be an equities person, so I do dabble in the markets. I have an option and call model that I run as well. So my preferred asset class would be equities in 2019, but I'd be very careful.
Okay, fair enough. Kunal, what about you? Are you putting all your money in gold, or will you also look at equities and maybe some other asset classes?
No, I never recommend to put all the money in gold, but the allocation can be higher. If you are 10%, if your portfolio comprises of 10% gold, then perhaps this is the right time where you can increase that to 15 or perhaps 17%. I think gold is definitely going to outperform for at least 2-3 years going forward. So a higher allocation to gold is something what I advise. I'm not condemning the other asset class, but I think gold has a better chance to outperform other asset class.
No, absolutely. That was just said in jest. We take your point. I think that it's a lot to think about, really. Why miss out an opportunity if indeed gold is going to do well? Final thoughts with you, Mr. Bhave. Of course, your choices, personal choices, and any words of advice that you'd like to leave our viewers with.
So I will always put my money where my mouth is. So majority of my money in the next year would go into equity, either through mutual funds, portfolio management, or direct stocks. Just one point I want to make, because that's what we are finding a lot of our investors, because I miss that in real estate. There are and you will hear these terms going ahead on this show itself. You know, there's a lot of interest on new avenues like student housing, warehousing, co-working spaces. And pre-lease commercial assets. That's where people are putting in money. But as an overall advice, I would say be very careful. It's your hard-earned money. Look at asset allocation, equity overweight. Look at all the products we have discussed. Have a gold as a hedge in the portfolio. And if you don't have it, go ahead and buy the dream house.
Okay, all right. Well, that's sound advice. Thank you very much, gentlemen, for being with us and educating our viewers about perhaps what lies ahead in 2019. We wish all of you a very, very happy new year as well. And of course, a very happy new year to all the viewers of Money, Money, Money out there. May 2019 be brilliant and bright. And of course, may it be a very prosperous year for you and your families. We'll see you in the brand new year 2019 next week.